Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today we're kicking off with some significant findings from the BMO Real Financial Progress Index, which reveals that high interest rates are keeping many Canadian home buyers on the sidelines. According to the survey, a notable 67% of prospective buyers are holding off on purchasing a home until borrowing costs decrease.
That's right, Steve. It's a tough situation for many Canadians who are eager to enter the housing market but feel constrained by the current economic climate. The rising recession concerns, which jumped from 60 to 74% between March and April, are adding to the hesitation.
And Robert Kavcic, a senior economist at BMO Capital Markets, pointed out that the housing market is under pressure as inventory builds and investors remain on the sidelines. It seems like half of Canadians feel that homeownership is less attainable now compared to a year ago.
It's particularly disheartening for younger Canadians, especially millennials. 66% of them believe they've missed their opportunity to buy a home. Only 14% of those hoping to enter the market plan to do so this year, with many looking to 2026 or beyond.
Cost is definitely a sticking point. The survey notes that 38% of potential buyers are waiting for interest rates to fall to 3% or lower. Meanwhile, 44% are uncertain about what rate they would find affordable.
And with traditional paths to homeownership becoming less viable, we're seeing Canadians explore alternative approaches. 45% are open to co-purchasing with friends or family, and 52% would consider relocating to a different province or even another country to afford a home.
Interestingly, despite these challenges, 70% of Canadians still feel confident in their financial situation. However, concerns about unexpected expenses and housing costs are significant, with 82% and 72% respectively feeling the pressure.
That's a good point, Steve. It's about finding new ways to achieve homeownership. Many are turning to tools like the First Home Savings Account or the Homebuyer's Plan from their registered retirement savings plans to support their purchase. It's all about adapting to the current economic landscape.
Let's talk about the recent changes in the Toronto area housing market. According to the Toronto Regional Real Estate Board's April report, home prices in the Toronto area have dropped by 4%. This shift seems to be giving buyers a bit more negotiating power.
That's a significant development, Steve. With the average home price now at $1.1 million, this may offer some relief to buyers who've been struggling with affordability issues. It's a small change, but for many, every bit helps in their pursuit of homeownership.
Absolutely, Janine. Interestingly, while sales did increase by 1.8% from March to April, they're still down 23% compared to last year. This tells us that despite the slight drop in prices, the market's still adjusting to broader economic uncertainties.
And with new listings up by 8.1% year over year, the sales to new listings ratio is at 29.7%, indicating a buyer's market. More choice for buyers means they can be more selective, which is a positive shift for those looking to purchase.
Jason Mercer, the Chief Information Officer at TRREB, mentioned that the preconditions are there for a market recovery once there's more economic certainty. However, people are hesitant to make large financial commitments without clarity on the economy and employment.
It's understandable that people are cautious. The housing market can be quite volatile, and with detached homes, semi-detached, townhomes, and condos all seeing price drops, it's a tough landscape for sellers, but potentially promising for buyers.
The report also highlighted that condos are experiencing the most significant price and sales declines. TD's forecast suggests that condo prices might drop between 15 and 20% by the end of 2025, from their 2023 peak.
That's a steep decline, Steve. It seems like the condo market is particularly struggling, which could be due to a combination of oversupply and changing preferences among buyers. People might be looking for more space, which condos typically don't offer.
The Bank of Canada's decision to pause interest rate changes on April 16th also plays a role here. Buyers might have hoped for a rate cut, but with U.S. tariffs potentially impacting prices, a rate cut might not be the best move right now.
True, Steve. But the flip side is that lower home prices combined with stable borrowing costs could make monthly mortgage payments more affordable for those who are ready to buy.
Let's delve into the current state of new home construction in the Greater Toronto Area, Janine. It seems like the math just isn't adding up when it comes to meeting housing goals. Marlon Bray reports that the target is to build 1.56 million new homes by 2031, yet the current pace suggests that we might not meet this target until 2041.
That's concerning, Steve. The gap between the target and the current pace highlights some systemic issues. We started 72,118 new homes in 2024 in Ontario, but we're already behind by about 200,000 homes. It's disheartening to see how far we are from achieving these goals, and it's impacting so many people who are waiting for affordable housing options.
Indeed, Janine. The drop in housing starts is staggering. In Toronto alone, housing starts have plummeted by 65%. Even purpose-built rentals, which many hoped would alleviate the crisis, are seeing a decline in starts by 25% year-to-date. It's clear that the current strategies aren't yielding the results we need.
And with unemployment and construction rising, it's a double-edged sword. Fewer homes are being built, and fewer jobs are available for those in the construction industry. It's a tough situation all around. The social housing waiting list is only growing, adding to the pressure on the system.
Marlon Bray also points out the issue with development charges and taxes. Despite promises to hold or reduce these fees, they remain a significant burden on developers. Even with reduced charges, projects barely break even, making it difficult for developers to justify new builds.
It's frustrating, Steve. The financial viability of projects is crucial for increasing supply, yet the math just doesn't seem to work out. And with property tax increases, service levels are declining, adding another layer of complexity to an already challenging situation.
Bray suggests that policy changes could help, but they need to incentivize rather than disincentivize development. Rent control, for example, hasn't proven effective elsewhere, yet it continues to be a focal point of policy. It's critical that we explore solutions that truly address the root of the problem.
Absolutely, Steve. We need to find a balance between regulation and encouraging development. The private sector has the potential to contribute significantly to affordable housing, but they need the right conditions to do so. Removing unnecessary red tape and easing financial burdens could be a step in the right direction.
It's clear that a more streamlined approach is necessary. Less bureaucracy, fewer fees, and a focus on building could help bridge the gap between current capabilities and housing needs. The market is in desperate need of more supply, and it's critical that we find a way to meet this demand.
I agree, Steve. It's about making sure the math adds up, not just for developers, but for the individuals and families who are waiting for a place to call home. We need to ensure that our policies and actions reflect the urgency of the situation.
Let's shift our focus to a recent and rather concerning development in the mortgage industry here in Ontario. Sussman Mortgage Funding Incorporated, a former Ontario licensed mortgage broker and administrator, has been placed into receivership due to alleged financial misconduct and multiple investor lawsuits.
That sounds serious, Steve. The Ontario Superior Court of Justice has appointed B. Riley Farber Incorporated as the official receiver for Sussman Mortgage Funding and two of its connected companies. This action was prompted by an application from Ontario's Financial Services Regulatory Authority, which raised concerns about how the company was handling funds.
Exactly, Janine. It seems that Sussman Mortgage Funding stopped making interest payments to investors, failed to repay loans, and didn't register certain mortgages. Even more troubling, they discharged some mortgages without notifying investors, or repaying related loans. As of the end of March, the company no longer had any licensed mortgage brokers, and their licenses have now been revoked.
It's unfortunate to hear about such a breach of trust. The appointed receiver, B. Riley Farber, has been tasked with managing all of Sussman Mortgage Funding's assets and investigating financial transactions. This includes overseeing mortgage loans and agreements, particularly looking into the company's syndicated mortgages and joint venture deals. These deals are connected to various residential development projects across Ontario, like in Innisfil, Mara, and Muskoka.
The court has capped the initial fees for the receiver at $300,000, with any additional costs needing further approval. B. Riley Farber is also permitted to bring in consultants or legal support to help sort through this financial and legal situation. They are required to file a preliminary report with the court within 30 days, with a follow-up case conference scheduled for late June.
It's a complex situation, Steve, and it highlights the importance of regulatory oversight in the mortgage industry. While it's a tough time for those affected, having a receiver in place to untangle these issues is a step toward resolving the situation. It's crucial for all involved to stay informed as developments unfold.
Let's dive into the recent report from the Toronto Regional Real Estate Board, Janine. April home sales in the Greater Toronto Area followed the usual seasonal trend with an increase compared to March. However, when we look at the year-over-year data, total residential transactions are down. This suggests that potential buyers are still on the sidelines, waiting for more favorable borrowing costs and economic certainty.
That's right, Steve. It's a tough balance for many households, especially after the recent federal election. People are closely watching how our trade relationship with the United States evolves. TRREB. President Alekia Berry-Sproul mentioned that a positive turn in this relationship could boost consumer confidence, making the market more affordable and better supplied.
Indeed, Janine. According to the report, GTA Realtors reported 5,601 home sales through TRREB's MLSR system in April 2025, which is down by 23.3% compared to April 2024. However, there's a silver lining with new listings up by 8.1% year over year. This increase in listings gives buyers more options and negotiating power.
And with the MLS Home Price Index composite benchmark down by 5.4% year over year, buyers are finding more affordable opportunities. The average selling price has also decreased by 4.1% compared to last year, which is a relief for those struggling with affordability.
Jason Mercer, the Chief Information Officer at TRREB, pointed out that inventory levels are historically elevated, providing substantial choice for buyers. This environment allows buyers to negotiate better purchase prices, translating into more affordable monthly mortgage payments.
It's a positive shift for buyers, Steve, but there's a long-term concern. As demand grows with immigration, we need to build more homes to keep up. However, pre-construction sales have been trending lower over the past year, leading to fewer housing starts. This could dry up the supply pipeline if not addressed.
John DiMichele, TRREB's CEO, emphasized the need for collaboration with all levels of government to promote fair taxation, reduce barriers for first-time homebuyers, and expand housing supply options. It's crucial that these initiatives are effective in sustaining the market's growth.
Absolutely, Steve. It's about creating a balanced approach where we not only focus on immediate affordability, but also ensure a robust supply for the future. By working together, we can address these challenges and support more Canadians in achieving homeownership.
Let's shift our focus to the Waterloo region, Janine. Despite some price drops, home sales in the area are still sluggish as buyers remain hesitant. According to the Cornerstone Association of Realtors, sales were down by 14% compared to last year and 27% below the 10-year average for April.
That's a significant decline, Steve. It's clear that buyers are still cautious, perhaps waiting for prices to stabilize further or for more favorable economic conditions. The market seems to be rebalancing, but it's a slow process.
Exactly, Janine. With inventories well above the 10-year average, it seems like buyers have more options, which is good news for them. However, sellers are having to adapt by being strategic with pricing and exhibiting patience.
It's a challenging time for sellers indeed. The data shows that condo sales fell the most year over year, followed by townhouses, detached houses, and semi-detached houses. It's a complex landscape with various housing types being affected differently.
The benchmark index for Kitchener and Waterloo shows a 6.1% drop in home values year over year, while Cambridge saw a 3.4% decline. This suggests some areas are feeling more pressure than others, possibly due to local economic factors.
Yes, and the average sale prices also reflect this trend. Detached homes sold for an average of $789,639, townhouses for $615,982, and condos for $473,079. It's a mixed bag, and buyers are likely weighing their options carefully.
The key takeaway here is that while there are more homes available, the pace of sales hasn't picked up as some might have expected. This could be due to broader economic uncertainties or potential buyers waiting for interest rates to decrease.
Absolutely, Steve. It's a time for buyers to be strategic and for sellers to be patient. With the right approach, both can navigate this market effectively, but it requires careful consideration and planning.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.